An option is a contract that you can purchase that gives you the right to buy or sell stock at an agreed price on or before a particular date. Now, you can also sell an option contract, where you would be selling this right to someone and collecting a premium for it. Okay, I'm sure that sounded very confusing, especially if this is new to you, but just bear with me as we get through a few more definitions. Once we get through these definitions, we'll be able to show you some examples and it will all start to make sense. But go ahead and take notes and write down these definitions so you can refer back to them during the rest of this course if you need to. Okay, there are two types of options, calls and puts. A call option gives the option holder the right, but not the obligation, to buy shares of stock at an agreed upon price on or before a particular date. And a put option is the same thing, except it gives the option holder the right to sell shares of stock at an agreed upon price on or before a particular date.
Okay, he did a really good job of giving you an introduction as to options, but option trading can be a great way to grow your income, limit your risk, and hedge against market fluctuations at the same time. For these reasons, options can be a complementary to stocks in your portfolio. When investors combine the two together, they have more possibilities than if they traded stocks alone. Options can act almost like an insurance policy, and I'm going to explain exactly how that is at the very end of this video. For example, if you own a stock and your stock decreases in value, but you're buying certain options, you can cancel out the potential losses of your shares. All right, so what are options? You just heard that an option is a contract giving the investor the right or the option, but not obligation to buy or sell a specific stock, ETF, index fund, whatever it may be. So when that specified time ends and the option expires, it no longer has value or no longer exists. Now, that's a little bit confusing as well. So I'm going to go through some actual representations to show you exactly what options are. And basically, one option is really a contract for 100 shares. So if you have a call option, you're buying it and you're predicting basically the price will go up by a particular date. And if you buy a put option, you're buying the rights to 100 shares and you're saying it's going to go down by a particular date. Okay, there's really two main sites that I use to check options before I actually go to my stock account and actually try to figure it out. So this is really stock option part one. So we're going to have to go into a little bit more detail when we go into some of the Greeks and picking out actual strike prices. But if I can help you now, I will. All right, let's just pick any stock. So let's see right here, and I've already done this in the future videos of all these different things, but in this time, we're going to go to something called options right here. Now, the way you read this chart is there's two areas, the blue and the white, or the colored and the not. Okay, and they depend on the strike price. So we do notice that right now, Apple is at 157 and 37 cents. So when we go down here and we look, and we're getting the full option chain. Where is the number that's closest to that and also under? And that is the 155, and these are called strike prices. Now, in order to buy, and this is on a particular date as well, so we need to investigate that. And it says September 16th. So this is basically next week. We can do longer term options by just clicking this button and say, I really believe, and I want to give myself time. I personally like longer options. So I'm going to go to June 21st, 2024. So these are your strike prices, okay? And this is the volume of people that are actually selling them, okay? You have open interest and the volume of actually people that are buying those sorts of options. So we're going to drop down here and we're going to take a look at it. Now, there's some very confusing parts to this. Let's say that I want the rights to buy Apple at $155. Remember, right now it's at 157, but we're actually thinking by buying a call option that it's going to go up, and we're thinking by 2024. Now, these are the prices. Now, when we look at this, this means this is the last price that one sold for. This is what somebody's bidding, and this is what somebody's asking so that you can purchase it. And someplace in between, and I'm going to teach you in part 2 about limit buys and how to actually execute an option. But those are pretty expensive. How you read this is you have to move the decimal point over 2 places to the right, okay? Because you're buying 100, the right to buy 100 of these. So an easy way to figure out how much this option will cost is by moving it over 2 places to the right. So this is going to cost me $3,160. Now, okay, that gives me the right to buy 100 shares at $155. So this has to go up to, and we're going to add this to it real quick. So it's going to have to go up to 186.60 in order for me to break even. So if it goes over that, okay, I will actually make money on this trade. If it goes above 155, which is my strike price, and it holds there, and it goes up, I will be able to execute this, and I will be buying it at $155. That's if I let it go to the term period, which was June 21st, 2024. I can sell this option tomorrow, the next day, 6 months from now, anytime up until that time period. Now, if I'm left and it's in the money, meaning that my strike price is below whatever the price of Apple is on that day, that means they'll go into my account and they're going to ask for, in this case, $15,500, and they're going to give me 100 shares of Apple. So these are call options, and these are some people, like you can see how they go all the way out, and they're saying 225, and they're paying $839. Now, we can't see any of these last purchases because nobody's bought them as of lately. Okay. There's 590 people that have purchased at $1.25, which is that's $125, the 320, okay, price. So they're saying that it's going to go up double, a little bit more than, well, yeah, no, about double. That 160 times 2 is double. So they're betting on it. Now, if it doesn't go up to there, the only thing you lose is whatever this premium is. These are called premiums. So that's the only risk that you have. So in this case, you have 3160 out. And in this case, you have less. Now, why is it sometimes better to be in the money? Because your chances, and we're going to discuss some of the Greeks and volatility, lends to the fact that it's much easier, okay, for this to go up to 186 than it is for it to go up to 320 plus 125, which is 321.25. Okay, the chances of being in the money and actually making money are greater. And again, we're going to be taking a look at some of the volatility indexes in part 2. Now, let's just say I think it's going to go down by this time period. So these are called puts, and I buy to open as well. You would buy to open if you wanted to purchase that 155, okay, and you sell to close, okay? So that's obviously very important. Right here, okay, I'm saying that there's the 155. I'm thinking this thing's going to go down, and it's going to crash with the market. And right here, you see that there's quite a few people, 526, that have purchased these. So they purchased 145 at $1,705. That's pretty expensive. This is $21.32, and this is $23.05, because again, 155 is outside the range this time. Remember, the strike price is actually at 157 now. So this is the one that's actually the most in the money. So let's just take this one, for example. This is 160 strike price. That means you would have the right to sell the shares at $160. Okay. So that's going to cost me $2,305, moving the decimal over twice. I take this, and it has to, and I'm going to subtract it this time. So that's going to give me what, 137.95. So if it goes to 137 in this range, okay, I'm already starting to make money. Now this one, okay, if they pay, let's just say $1,200 for this one, all right, it still has to go. Let's just subtract another 1,200, 120 from that. So it has to go to 128, okay, in order to make money. All right, now I know some of this looks fairly confusing, okay, but it's one of those things that you have to kind of practice with and think about after a period of time. Now, I can show you some trades, and I will in part 2, that shows you exactly some of the trades where I've bought in both call options and put options, and I have some in the money and some that aren't in the money. And again, if they expire worthless, you don't have to do anything. You don't have to sell the close anymore. You just lose whatever your premium is that you put in. So that's a very interesting way of hedging, not only hedging your stock portfolio, but also making a lot of money. I hope you found this very helpful. And as always, have a wonderful and blessed evening, and look for part 2.